And there will certainly be a lot of follow-up discussions and some strategic planning that goes into this or that comes from this tax bill. So I think, as far as, if you take some notes and just jot some things down, that's great. But we'll certainly be in touch with, our clients, certainly as the tax filing season gets going and providing some projections for 2018 and what that might look like. Obviously implementing some of these other business strategies. So there's a lot that we'll be following up with, with a lot of you. So
this is one of the biggest pieces of tax legislation we've had since I think 1986, which is actually when I started with the firm, was a big piece of legislation. So this is a pretty big sweeping legislation that we've got here, covering multiple different areas, both individual and corporate, and can handle trusts and some changes with the estate exemption amount. We're going to start out with the individual piece. We're going to talk about some of those changes. Mike's going to talk about those. And then we're going to move a little bit on what's happening with the estates and the trusts. And then I'm going to talk about some of the business changes. And some of the changes might relate to the pass-through entities or some of the deductions in the business area.
What we'll start with here is just going through the changes to the tax brackets. And we're going to go through these pretty quickly. I think a lot of you have probably seen some of this already. It's certainly been published, in a variety of different ways. So the first thing we'll go through is the tax brackets for joint returns. And the left-hand side of the schedule you see there marks the prior law. The right-hand side of the schedule marks the new law. Couple just, observations here. You can kind of compare and go down the left and the right side. But what we're seeing, as we run some of these projections out, if you look in that $300,000 category as an example, we're seeing some significant savings there. If you look at under the old law, if you were at $300,000 of income, you were paying a marginal tax rate of 33%, whereas under the new law, you're at 24%. So, depending on where you fit in, where your income fits into some of these revised brackets, you'll certainly see some greater savings in certain situations maybe than others. Also, once you start getting up into, the top rate now is over $600,000, and that's 37%. We've noticed too, once you start really looking up at the higher income levels, say $1 million or more, without factoring in some of the other incentives, you start to see some scaling back, and the tax savings is not necessarily as noticeable. And you combine that with, as you get above those $1 million levels, the loss of deductions, which we'll talk about a bit, has a pretty significant impact as well. The head of household tables, just one observation there. Kind of look at if you're looking at somebody making $180,000, under the prior law, they would have been at a marginal rate of 28%. Under the new law, they're at 32%. So this would be an example possibly of somebody, depending on what their other facts and circumstances are, they may actually end up paying some additional tax. So while we haven't seen a lot of these situations where taxpayers are paying more under the new law versus the old law, we do see some situations there. Again, there a lot of moving pieces to this, and we'll talk about that as it relates to deductions and whatnot. But just an observation there. Moving along to the the brackets for single taxpayers. First of all, if you compare this to the married filing joint table, the rates and the brackets, the brackets are about 1/2 of the married filing joint schedule, up until you get to the higher tax brackets, the 35 and 37% brackets, where things start to scale back, and there isn't very much difference between income as a single tax, or the marginal rate for single taxpayers versus married filing joint. For kiddie tax, historically, if you had children that were under 19 years of age or in college and under 24, they would be paying tax at the parent's rate on certain types of income, and that income was typically dividends, interest, capital gains, certain other types of passive income. Under the new law, there are just statutory tax rates that they will pay, which are based on the revised trust tax rates. So you can see that for those that this applies to, it would only take up to $12,500 of investment income for the kids. They're paying tax at the top rate already. One thing is the compliance will be a little bit easier on this. Historically, we always had to finish completion of the parent returns in order to determine what tax rate they were in so that we could apply that to the kids' returns and the separate forms they're in. But that is no longer going to be necessary, so a little bit easier. And I don't know that the tax at the end of the day is going to be noticeably different than what it was before. It really depends on where the parents, what tax rate the parents were in before. So you could be looking at just not much of a difference. For capital gains, so this is really the long-term capital gains tax, which would include tax on qualified dividends. No real changes there. Just putting it here in the presentation because I know a lot of people have asked, well, what are the there's obviously all these changes to the tax rates and brackets, and what does that mean for capital gains? And for long-term capital gains, there are no changes. Make note there, though, that the 3.8% net investment income tax, which is really some call it one of the Obamacare surcharges, that still exists. And again, that's imposed on taxpayers whose overall income, if you're married filing joint, is over $250,000. So your investment income would be potentially subject to that additional tax. But again, no changes there. That's still on the table. Like I say, there's been a lot of news, obviously, and one of the more popular items you hear about is the change to the standard deduction and personal exemption. I think a lot of you are probably already aware of this, but what we're seeing is effectively doubling of the standard deduction for most taxpayers and an elimination of the personal exemptions. And what this will do at the end of the day, especially as it relates to the change to the standard deduction, is that this will really have a tremendous impact on those who have historically itemized. So you couple this higher standard deduction along with a loss of some of the itemized deductions that we'll talk about in a little bit, and there will be a significant reduction in the number of individuals who are itemizing. And in some cases, this will even apply to some of the higher income individuals, depending on what their other items are. So certainly be a lot of change there. Okay, so moving on to some more of the specifics with these itemized deductions. The first item there is there's a suspension of the 3% of AGI limitation on itemized deductions. So again, under the prior rules or the rules in place through 2017, as an example, if you were married and your income was around $315,000, I don't have the exact number, but once you exceeded that income level, you started to lose the benefit for some of your itemized deductions. So that's a plus for the taxpayers. We don't have to worry about that, and those, to the extent your itemized deductions are eligible, there will be no phase out based on having a higher level of income. Second item there, the medical expense deductions are still allowed. One thing to note, so the 7.5% of AGI limitation is still in play for 2017 and 2018, and then it increases to 10% after that. If you recall, and there was certainly a lot of news about this, the House version had called for an outright repeal of this, but there was enough outcry for keeping it, and the Senate version kept this on the books and eventually prevailed there. So we still do have the medical expense deduction available. Third item there, this is the big one, and this is the one that will affect almost every one of our clients, I would say. Certainly, anybody, other than maybe some of the children's, returns that we prepare, is the combined $10,000 limit on the deduction of state and local income and real and personal property taxes. We'll talk about that in some examples, but that $10,000 limit is going to be tremendous, and it'll really, change some of the planning really that's done as far as when those items are paid and things like that. The mortgage interest deduction. No real change here for existing mortgages. So if you have an existing mortgage where the acquisition debt is less than $1 million, you still get a full deduction for the interest expense. However, going forward, any new mortgages, that acquisition debt limit is now $750,000. Another note on there is that refinancing acquisition debt would still be allowable up to $1 million. As far as home equity loans go, those will only, the interest attributable to home equity loans will only be allowable to the extent you have home improvements essentially. So if you have home equity loan for cars or boats, what have you, that deduction will no longer be allowed. That will completely be eliminated. And it's not grandfathered in like some of those other, the previous interest rules allow. So more itemized deductions here. Not much has changed in charitable contributions. They have changed the AGI limitation has gone up from 50% to 60% of AGI for cash donations. So we don't see that a whole lot where folks are limited to what they can contribute. The carryover, to the extent the donations exceed those amounts, the carryovers are still available like they always had been. Athletic ticket seating rights will no longer be deductible. That was a specific provision as part of this bill. Hopefully this is one that doesn't apply to too many folks out there. Is the personal casualty and theft losses has been suspended. There is an exception there for federally declared disasters. There's a few items there on federally declared disasters. Feel free to take a look at them if that's something that you know somebody or might apply to you. If you have property down in Florida that may have some hurricane or something like that at some point, hopefully not, but some more information there. Just a few more itemized deductions to cover. So all miscellaneous deductions which were subject to the 2% of adjusted gross income limitation have been suspended. Bottom line on these is we just weren't seeing very many people really getting the benefit of these to begin with. There's always exceptions, and some folks did, but for the most part, the higher income earners who had some of these just weren't getting much benefit for a couple of reasons. Obviously, you have the 2% of AGI limitation there, and number two, they were not allowed in computing alternative minimum tax. So between those two items there, you just, a lot of times we're not getting much tax benefit. So I don't know how many people are really going to be impacted by those lost potential deductions, but that's just something to note there. There's a listing there, those 3 points below, on what some of those items might be. Gambling losses. So for the most part, for recreational gamblers, there really has been no change. So deductions are still fully allowed to the extent of winnings. The provision that they've added really affects professional gamblers in that some of their other deductions, like travel expenses, if they have racing programs and things like that that they purchase that are part of their their trade of being a professional gambler, will have some additional limitations there. But again, for the recreational gamblers, nothing has changed. Those rules allowing the losses against the winnings, or to the extent of winnings, still stand. Okay, so here are a few planning items to consider. As I mentioned earlier, the new higher standard deduction means there will be fewer taxpayers that itemize. So bunching deductions in a single year to exceed the standard deduction will help maximize the efficiency of those deductions. One example of something that folks have been considering or may continue to consider going forward is using a donor-advised fund, and that would entail making larger contributions in years when you itemize. So a real simple example would be, let's just say I donate or make donations to my favorite charities on average of $5,000 per year, and rather than and assume I'm not getting any benefit for those deductions because of these new rules. Okay, I'm using the standard deduction every year, so I'm not getting benefit from my itemized. Well, as an example, I might say, well, I want to cover 5 years of those deductions in 1 year, at least for tax purposes. So I could contribute $25,000 to a donor-advised fund. Assuming that I have other itemized deductions, I can get benefit for that deduction once I fund it. And then through that fund, over whatever period of time, I'm just using 5 years as an example, I can spread those dollars to the organizations that I choose to, which is essentially the same thing I would have done before, except under this strategy, at least I'm getting some benefit from a tax perspective for making those, for using that donor-advised fund. So, you see that a lot more being used now just for this very reason. If I was making if I'm getting benefit for a $25,000 deduction and I'm in the top tax bracket, 37%, you're looking at potential savings of around $9,000. So it's something, folks, understandably have been considering. For some of the older taxpayers who are collecting required minimum distributions or taking required minimum distributions, they can make contributions directly to the organizations out of their IRA rather than pushing it through as an itemized deduction. So they're getting a direct deduction from income for doing that. And that's becoming a real popular strategy now, again, for those folks that historically would have been itemizing and just writing checks out of pocket to do that. This is certainly a strategy that can save some taxes. Healthcare savings accounts are listed there. Nothing new on that. It's just those are always good ideas, I think, if you're eligible to utilize one. One item that's not listed here, but maybe should be, is watching your mortgage interest. So if you're now in a situation that you're using the standard deduction, that mortgage interest isn't providing you any tax benefit. So if you're looking at your personal situation and you have cash sitting in a bank account that's earning less than 1% interest, and you have this mortgage interest out there that's not providing you any tax benefit anymore, it's maybe a time to at least consider just paying that mortgage off, since some of the benefits you were getting before are now gone. Okay, so moving on from itemized deductions and some planning things, so talk about a few income adjustments. First one there is alimony, some changes there. So alimony payments will no longer be deductible by the payer and no longer taxable to the recipient. And that will be effective for agreements executed after December 31st, 2018. So any existing agreements in place, no changes apply to those settlement agreements. Another item, moving expenses have been suspended. There's a military exception there for that. Roths, new rule there is we cannot unwind a Roth conversion. However, you can still convert from a traditional IRA to a Roth, but once you've done the conversion from an IRA to a Roth, you just cannot undo it any longer. Okay, moving on to more income adjustments. So distributions from 529 plans can now be used for elementary or secondary school, so up to $10,000. And just in general, I think our other folks here would agree. In general, these are great. If you plan on or you're pretty confident you're going to be funding the education for your kids or your grandkids, to put the money in these accounts and have the earnings grow tax-free for as long as you need to until they pull the dollars out for school, I think just makes a lot of sense rather than having those funds in accounts where you're paying tax on them. So just a note there. There's some more information there on allowable expenses, things like that for purposes of distributions. A few other items on the slide there that I think we can move past for this purpose because I think they're fairly unique. And getting on to some of just the Obamacare provisions, the individual mandate for health care or health insurance goes away after 2018. I know a lot of people are hoping this is the beginning of the end of Obamacare. Well, we'll see. A lot of people feel that's the case, and I hope it is, but like I said, we will see. I mentioned earlier, no change to the 3.8% net investment income tax and the additional 0.9% additional Medicare tax, so those still exist. Pretty major changes as it relates to alternative minimum tax, and I know probably a lot of you out there, it depends how closely you look at the tax returns when we give them to you, but a lot of you are probably in an alternative minimum tax situation, and maybe didn't even know it. Not that there's anything, obviously we do everything we can to avoid it, but in certain situations, or a lot of situations I should say, it was just completely unavoidable. But this is some pretty big change that made its way through on this. And the biggest item you'll see there, you just follow the joint schedule there. The exemption has gone up, which is great. But really the item that's most significant is this phase-out threshold, where taxpayers previously, once they reached over $164,100, were starting to lose the exemption that was there. Well, now that phase-out is at $1 million. So bottom line on this is, as I see it, very few taxpayers are going to get hit with the alternative minimum tax. I say that, and I'm sure there's an exception out there, for some kind of unusual adjustment. But for the most part, we just should not see many of our clients paying alternative minimum tax anymore. You couple that with some of the other adjustments we've talked about with lost itemized deductions, and it's hard for me to imagine that being the case. Okay, so we have also an enhanced child tax credit as part of this legislation. Child tax credit has increased from $1,000 to $2,000 per child. The age limit or the age ceiling on that has not changed, so it's still for kids under age 17. The refundable portion has increased from $1,000 to $1,400. I think if you recall, that was the one where Marco Rubio was really kind of drawing a line in the sand, and I think it even at one point threatened to not follow the other Republicans on this bill, and eventually they agreed upon $1,400. I think he wanted it to be closer to $2,000, but ultimately settled at $1,400. There's also a new non-refundable credit of $500 for non-child dependents. So that would be for, example, parents living with the taxpayer, and assuming the other requirements are met, there could be a credit available there. Going back really quick on the refundable portion, a lot of people sometimes ask this, well, the refundable portion of these credits would apply to individuals who otherwise don't have a tax liability. So even though their income may be at a certain level where they don't owe any tax, but they still have qualifying kids, they would still be eligible to get some of these credits. The last item for these credits is the phase out, which has seen significant change. Similar to alternative minimum tax, where there was a huge increase in the phase out, seeing something similar, in my opinion, as it relates to child tax credits. So under prior law, you were looking at joint taxpayers, once their income exceeded $110,000, they started to lose the benefit of these credits. Well, now under the new act, we're looking at $400,000. So that's going to be a significant increase, and a lot more taxpayers are going to be getting those credits. Okay, so now we've covered some of the changes to income deductions, the rates, etc. Let's take a look at a few examples to get a better visual of what this might look like. So try to make some really simple examples here, but I think that hopefully either yourself or some folks that you can kind of apply this to and just give some thoughts. So first example here, we'd be looking at married taxpayers with 2 kids, both under age 17. They have wages and other income, $150,000. Deductions start with state income and property taxes of $18,000, mortgage interest of $8,000, and charitable contributions of $5,000. So the total deductions there, $31,000. So on the left-hand side of the schedule is the tax calculation under prior law. So we'd have adjusted gross income of $150,000. We have allowable itemized deductions of $31,000, which exceed the standard deduction in place of $12,600. So that's why you see the strike through there. We either get the itemized or we get the standard deduction. Don't get both, the greater of the two. So we take $31,000, and personal exemptions still available under the prior law would have been $16,200. So doing the math, we would have taxable income of $102,800, resulting in a tax liability of $17,243. So then if we layer that on to apply some of those items to the new law, adjusted gross income is not going to change. Allowable itemized deductions that we've stricken through there, $23,000. You say, well, why is it $23,000 under the new law versus $31,000 under the old law? Again, our state income and property taxes are limited to $10,000. So even though we have $18,000 listed up there, we're not going to get benefit for $8,000 of those. So we had $10,000 for our state income and property taxes, $8,000 for the mortgage interest, $5,000 for the charitables. So the most we could get out of itemized deductions is $23,000. Well, in this example, like we talked about earlier, so we said we're going to see fewer taxpayers itemizing, and this is a perfect example of $24,000 standard deduction. So we're clearly going to take the greater of the two. That leaves us with taxable income $126,000. Now you kind of look at between the new law and the prior law, taxable income is quite a bit more. We have a tax before credits of $19,599. And in this case, we do get the child tax credit, again, as a result of the increase in the phase-out up to $400,000. So they get full credit, or full benefit for those credits, where under the old law they would not have received anything because of the phase-outs. So bottom line is, in this situation, we would have a tax reduction of about $1,644. Something to note on this example, though, okay, that's great for this particular taxpayer. They get some benefit out of this. If those two kids were 17 years of age or older, those credits go away, and they would be in a situation where they're actually paying $2,400 more in tax, roughly. So, like I said, it just depends on the fact pattern. For the most part, you're going to see folks doing better under this bill, but there are certainly situations where that might not always be the case. Okay, so I'll move on to another example here and just change the facts a little bit here and show a little bit more income. So again, married taxpayer, 2 children, both again under 17 years of age. Now, wages are now up to $500,000, and our deductions have been increased accordingly, okay? So obviously there's going to be more state income, assuming they have a little nicer house, more property taxes, etc., more interest, and a little bit more in charitable deductions. So under prior law, again, adjusted gross income would be our $500,000. Allowable itemized deductions, even though we have $72,000 of total itemized deductions, again, under those old rules, we start to lose some once our income exceeds around that $315,000 level. So we're only going to get $66,339 out of $72,000, leaving us taxable income of about $433,000 for a tax liability of $129,121. We'll layer that same fact pattern over to the new law, and again, allowable itemized deductions are only going to be $37,000. So why is that? We had $72,000 to start with, and we're down to $37,000. It all relates to, out of that state income tax and property tax deduction where we paid $45,000, we're only going to deduct $10,000 of that. That's our cap. So $10,000, $12,000, and $15,000 gives us our total of $37,000, and taxable income goes to $463,000. Tax liability, $115,679. So, fairly decent amount of savings there, $13,442 in that example. And a lot of that, the details aren't in the prior law tax calculation, but part of that tax under the prior law was related to the alternative minimum tax. So having that alternative minimum tax go away as well provided some really nice savings for this particular taxpayer. We'll just do a couple more really quick now to kind of put the facts out there. We'll just again really tick it up a bit, and getting us to again a married couple with 2 children. No changes there, but our wages are up to $1.5 million. So this would be really a high net worth individual or taxpayer, and the deductions would creep up accordingly as well. So under the prior law, again, you're losing more of those itemized deductions. We have $198,000 to start with, and the only amounts we could get deductions or utilization for would be $162,000. So there's quite a bit lost there. Bottom line is we would have a tax liability of $486,165. Layer that over to the new law. Even though we're losing a significant amount in deductions there, we go from having $198,000 in total deductions available up above to, by the time we run that through and limit our state income tax deduction, we're at $78,000. So you compare the two, obviously taxable income is quite a bit higher under the new law, which I think it will be in most cases, but our tax at the end of the day is lower, and we have a tax savings of about $9,400 roughly there. So as I mentioned earlier, as you start to get your income in those higher brackets, you do start to see some scaling back of the tax savings. And in this case, somebody who was at $500,000 of income had a greater had more tax relief dollar for dollar than somebody at $1.5 million. And really it comes down to those lost deductions at the end of the day, and you start to really see the cost of losing some of those deductions. But at the end of the day, again, it's somebody who's done better off under the new law than they were under the old law. Last example, I'm sure we all know folks in this situation, married taxpayer. In this case, I put 3 children in there. Under that scenario, if they have state income taxes, $10,000, and mortgage interest, $7,000, charitable contributions, $3,000. Bottom line is here at the end of the day, when you run it through, they would receive a tax reduction of about $2,300. So, for the most part, I've given you 4 examples here for various income levels, and not too complicated of things going on, but I think are pretty common. And you'll see, as you saw, there was some tax benefit in each one. So that just gives you a little bit of a visual of how the challenge is. We have our clients ask us a lot of times, well, hey, what is this new tax law? Am I going to save money? Is it going to cost me? There's a lot of moving pieces, as you can see, between losing deductions. There's new deductions available. Jane is going to talk about, obviously, some of the new business law changes. But it's at the end of the day, it's really having to run the numbers in order to determine what that is, because there just is a lot of moving pieces, and everybody's facts and circumstances are going to be somewhat different. So with that, turn it over to Jana here to get into the estate tax and some of the business tax provisions.
So one of the really nice pieces of this legislation that came through is an increase in the exemption amount or the exclusion amount for an estate. They had tried with the legislation to completely remove the estate tax. They've been trying to remove it multiple times, went away for a short period of time, came back with a pretty decent size exemption. So we were at about the 5 million range index for inflation, so it had creeped up to 5.1 or 2, but now they've doubled it to 11.2 per person. So if you have and they still have portability. So the estate tax is basically kind of a balance sheet tax on what you have upon your death. When we raise that exemption amount to 11.2, or on a joint couple return where you can have portability, which is still out there, you can have a significant estate value before you're going to pay tax. So really it is truly the really large estates that will still be subject to tax, but they've really taken it off and made it easier for everybody else that you won't have to normally compute some of those. There won't be that tax. So most of us in this room were outside of this limitation, and we don't have to worry about the estate tax. So that was a very significant part of the legislation that was very helpful for taxpayers. Some of the legislation items are permanent, and some of them have a phase-out. Most of the phase-outs go through the end of 2025. So this provision will expire at the end of 2025. So it is a thought process now. Do you want to do, if you're in a significant, close to these exemption amounts, or you think it will come back down to the $5 million, depending on who's in office at a particular point in time, it might be a time to consider gifting and taking advantage of these large exemption amounts now. We have a little bit of time, hopefully. There won't be any talk of new legislation on this area for at least a couple years, but it is something to consider right now. Do you want to do gifting to take advantage of these and keep your estate below the minimum, below numbers that they may change in the future? They had talked when they brought this provision in about taking away the step up in basis. The step up in basis, you get the date of death value as your basis in inherited property. That is still in play. You still do get the step up in basis. They did not eliminate that with this legislation. That makes it so much easier to, sometimes we don't know what the actual cost basis was of the person who passed away. So to use that date of death value, and there's usually an advantage over the course of time that value has increased. So using the date of death value is a very important part of the legislation that we have. So that's still in play. The estate tax brackets for the income tax part of the estate and trust did change comparable to the individual changes. So after somebody passes, whatever income is earned by their estate then flows into a trust return. Or you could set up a trust before death. Those rate brackets are on your slide. And those you can see are comparable, that dropped to 37%. You can see that brackets for trust, you get to the top bracket almost right away. And we did see this on the slide for the kiddie tax when we saw that kiddie tax is now using those trust brackets. So you're almost in the 37% bracket fairly quickly when you're in a trust. The legislation, one of the primary reasons for the legislation that they talked about was to put us on an even playing field with all the corporations that were taking their money outside the country and reincorporating and moving their assets outside the country. The U.S., we have a worldwide taxing system. So we're normally taxing everything in the U.S. Our tax rates at the corporate level are higher than many other countries. So one of the drivers behind the legislation was trying to change the tax rate for corporations. One of the other drivers was tax simplification. So we've heard what Mike had to say. I don't know if you think it's simplified any of the tax laws, and after we go through my part of the presentation, I'd be interested to know if you think it has simplified anything. But we did see a change in the corporate tax rate. Instead of our bracket system for the corporations, it is now a flat rate of 21%. So easier to calculate, but sometimes beneficial to many corporations. Some of the smaller corporations, which were trying to use the lower brackets, the first 50,000 was at 15%, they're going to see an increase, but any corporation that was making over 100 and some thousand, it will be a decrease down to the 21%. There are some personal service corporations who were paying a flat tax rate of 35%, so it will be a decrease for those corporations as well for their total amount at 21%. Corporations did also have a dividends received deduction where they were able to exclude 80%, or it has now gone to 80% and 70%. I'm sorry, reduced to 65 and 50%, where you used to exclude 80% or 70%. The difference there was whether you own 20% or more of a corporation, then you can exclude the higher amount. They did repeal the corporate alternative minimum tax. We heard from Mike that the individual alternative minimum tax is still in play, but not likely to affect many people. The corporate AMT tax, we didn't see very much application of the corporate AMT, so the repeal of that doesn't have a significant effect, but it makes things easier because you don't have to do two calculations on a corporation anymore. They did change the loss carrybacks to eliminate carrybacks and put in play just carry forwards, took away the limitation on how many years you can carry forward, so it's unlimited now. And all of those changes are effective for tax years beginning after 2017. We may see, and we're going to talk about this on a different slide, some companies that will consider should they convert from an S to a C corporation. If you do that conversion, we want to talk to you, obviously, before you make that determination, because there are some challenges with some of your previously taxed income that we want to plan around. Now for one of the really big items and changes that came into place in this new legislation. And what we haven't seen, we've seen some write-ups. We've seen 1,000 pages, at least 1,000 pages, I think, of write-ups of what this new law is. But when we get into it, we're going to see that we need some regulations to be written by the IRS to do some interpretation of some of these provisions. The individual provisions, I think, are a little bit more clear-cut. If they tell us, okay, your state and real estate taxes are limited to $10,000, we can understand that. But some of the provisions I'm going to talk about, it might be more into the definition of what some of these provisions are that we're going to need some more assistance with. And I think as we go through this, you'll have questions in your mind. Is this me? Is this not me that this applies to? So the 20% deduction of is a 20% of qualified business income for a non-corporation. This was trying to get the equivalent tax rate that the corporations were at. We reduced the corporate rate to 21%, but a pass-through entity such as an S corporation or a C or a partnership is going to pay tax on the individual return. Individual return rates did get reduced at a maximum of 37%, but that's still higher than the 21% of the corporate rate that we saw. So they put in place something to try and bring that rate down by putting in a 20% business deduction on most corporations. And there's a lot of rules with this 20% business deduction. But if we take kind of a little chain of thought process and say, the first rule is if your income is $315,000 or less on a joint return, you will get the 20% business deduction against your business. If your income is higher than that on the pass-through entity that we're talking, or it could be a sole proprietorship that you had on your individual return, such that you had qualified business income from it. If your income is over that level, then we have to look to some other tests. One of the tests are you a specifically identified trade or business that they just said you cannot take it on those types of trade or businesses? An example of that would be like an accounting firm. We wouldn't be eligible. Law firms would not be eligible. I think you can see them all listed here. Actuary services. Consulting, that's a hard one. Who is a consultant? How did you define consulting? What if your business produces something, but you also do consulting? Does that mean that you qualify? That's where we're missing the regulations here. That's where we're missing the interpretation. Do you look at the overall income of the company and what produces that income to say that the company qualifies and therefore you get the 20%? At this point, we're interpreting it to be that, but we need regulations that will tell us. And we'll probably see these as the year progresses. So as that comes out and is announced and we see those, we'll try and communicate that with you. If your principal service that you have to sell relates to the reputation of somebody or is some famous athlete, you do not qualify if you're over the income limit. So first, if you're under the income limits, you get the 20%. If you're over the limits, you look at, are you one of these types of trade or businesses? that's producing the income. If you are, then you don't get it. If you pass the test and you say, okay, no, I manufacture, that's my primary business. Rental real estate can also qualify as a primary if it's run as a trade or business. If that's what your trade or business is, you pass this test, then you go to another test. And the other test is even more complicated, but it is the greater of two tests. One, what is 50% of your basically W-2 income on that business? So you could take either the 20%, or you're limited to 50% of your trade or your 50% of your W-2 earnings. If you do not have any W-2 earnings, then that number will be 0, and you wouldn't be able to take the 20%. But there's another test. The other test is you can take the greater of that 50% of W-2 or 25% of your W-2s plus 2.5% of a tangible property test. The tangible property test is also another test we're probably going to need some regulations on. It's basically saying that you get it on what kind of property do you have in the business. And it's undepreciated property, so it's almost a separate calculation of depreciation. However, if you say you put a piece of equipment in that's $1 million, even though you take a quick expensing of that piece of equipment and you write it off, like we're going to talk later on bonus depreciation, and you write that all off, you still have a 10-year life on that piece of equipment for this test. So it's a different test than your standard depreciation, but it is a test on what do you have for property out there. So you can see how complicated this area is going to be when we try and run this calculation. But on a rental property, you might not have wages, so you're going to maybe get the deduction based on the second qualified property piece of the puzzle. After you calculate it on the business, this is claimed at the individual level. So after you calculate it on the business, you will have to net so that if you have one business that has a loss and one business that has income, you will net these two to determine if you have something when you're done that you take the 20% on. If you have a loss from a business, it could be a carryover for this calculation into the future against the future earnings of the company, because they don't want you to play games from year to year on whether you're trying to take a higher amount of the credit. But it is something to think about right now. If you're running a trade or business, perhaps you have a couple trades or businesses and your wages are in one entity, but maybe you do a management fee to the other entity, you may want to consider, should that entity have wages within it? Or will the fact that you have real or property investments in it allow you to take the 20% deduction? So a lot of moving pieces on how you get to that 20% deduction. But a significant deduction if you have significant income in the business. Certain things will qualify in that business income. There's a couple unusual areas, that dividends from a REIT, patronage dividends, and some qualified publicly traded partnerships will also qualify into the income. What won't qualify in the income? It's more your operating income. It's going to exclude what you're earning if it's dividends, interest, and investment type items. It's more getting at what's your operating profit of the business. The next slide details a little bit more that I had discussed on the qualified property, that's tangible property subject to depreciation. It has to be available for use at the end of the year. So if you placed it in service or took it out of service during the year, it has to be in service at the end of the year to qualify for that particular test. This provision does sunset in 2025, similar to what I had talked about on the estate provision. So most payers, kind of a summary, as I discussed, will be able to take, normally you're going to have enough wages if you're running a business. That probably won't be a big limitation. So as long as you're not one of the qualified specified businesses that are excluded, you'll probably be able to take advantage of the business or the deduction. What does this do to your effective tax rate? Well, if you were in the top 37%, this is going to move that effective rate if you get a 20% deduction against it down to about 29.6. So you can see that it's still higher than the corporate rate of 21%, but has come down a significant deduction. What do you want to do with your C Corp versus S Corp? Because I just told you now that the S Corp rate is still at 29.6 if you take the deduction. We're getting a lot of questions on that, and that's a very good question to have. We do have an example in the material of an S Corp versus a C Corp. Actually, we have a couple examples. Our first example is a manufacturing example. And the reason that there's a difference here, in Wisconsin, if you're a manufacturer, you basically, with all the credits and deductions you're allowed, are not paying state income tax on your manufacturing income. You also do get a DPAD, domestic production activity deduction, as a manufacturer. So we'll come back to that example second. The first example, you're not getting those. You are paying state income tax. So as an S Corp, the top individual tax rate that's being passed through to you on a Wisconsin return would be at 7.65%. The top corporate Wisconsin tax rate is 7.9%. If we subtract those and then take off the federal taxes, you can see that the total taxes paid are $372,500. I'm sorry, let's stop at the remaining available for distribution is $627,500 under the S Corp and $727,590 under the C Corp. So you do pay more taxes, or you do have more available to you after you pay your taxes under the C Corp than the S Corp. But you have to get that money out to the shareholders at some point in time. You're either going to take it out as additional wages, you're going to take it out as a dividend, or you're going to liquidate the company. At some point in time, you're going to get it out of there unless you plan on leaving it to charity. If you left the stock to charity, I guess then you wouldn't have that. But otherwise, if you have any plans at all of liquidating the company, taking a dividend out of the company, or taking additional wages to get the money out of the company, eventually you're going to pay tax. That tax comes out at a dividend rate of, you could take it out as a dividend, you'd get the cheaper rates currently at 15 or 20% depending on your tax bracket. You're still going to pay additional tax. If you liquidate the company, you'll get a capital gains rate, you'll still pay more tax. So you can see when you add that additional tax, the double tax on of the C Corp, it is still cheaper to be an S Corporation. The first one example we had was a non-manufacturer. If we run the same thing through for a manufacturer in our next example, if you have $390,000 of wages, $1 million in S Corp earnings, on the $1 million, there's a 9% domestic production activities deduction. That would equate to $90,000 of a deduction. You can see that your AGI under the prior law with the domestic production deduction was $1.3 million. Under the new law, that domestic production is gone, so that income is $1.390 million. If you look at your itemized deductions, and that has changed, you can see that under the new law, your allowable itemized deductions are $42,000. Your taxable income is $1.348 million. If we take 20% of that $1 million for your qualified business deduction, you would have a $200,000 deduction that would come off. And now your taxable income is less. Your taxes are less at the 37%. So you can see that there is now a savings under the new law of $81,000 in our particular example. I think I mentioned earlier that when we were talking about the qualified business deduction, that it is, the depreciation has been changing. They have played around with bonus depreciation from year to year. It was in place, it went away, it came back, it has a staggered period of time where it was going to be gone, but it's now back in place again. 100% bonus depreciation is available for anything that you want to place in service that qualifies. Bonus depreciation used to just be on new property. They've extended this so it can also cover used property. It has to be your first use of property. So you can't reacquire something that you had before and then take bonus depreciation on it. But otherwise, you have the ability to write off 100% of your acquisition cost. If you don't want bonus, you do have to elect out of the bonus. And so there might be reasons where you don't want bonus. You may be playing the game at one particular year. You want to maximize something with your 20% deduction and not claim the bonus on all of your property in one particular year. It is a class-by-class election, however, so if you have a particular class of property, it needs to be all or nothing on the class of property. They did also play around with some of the limitations on autos. They did increase the limitations that you can take, although they did limit, for some reason, they limited the amount that you can take of bonus depreciation. Regular depreciation, they increased some of the limits, as you can see in your material.
Gina, can I just quick comment, I guess? Or just make sure I'm thinking of it the same way, and just to mention to the folks, I mean, bottom line on the new depreciation and expensing, I mean, other than real estate, and even there's some exceptions there, and automobiles, I mean, it seems like you can write off or expense just about everything now, whether it be under the bonus rules or the Section 179, right? I mean,
yes, and they've
accurate?
extended 179, except for the real estate that Mike mentioned. They also, though, did extend what you can take 179 on to include, let's just go to that slide first. Some of the things that traditionally were considered real property are the heating and cooling, the fire protection, alarm system, and roofs. So they've also extended that. So except for maybe the shell of the building or certain pieces of the building, that's about everything else is
can be written off immediately.
in one place or the other.
So, okay, yeah, thanks.
The bonus depreciation is subject to a phase-out charge. So in 2027, it will go away. But we may see new legislation because they seem to continually bring this one back up. They want to encourage us to reinvest into tangible personal property. When they adopted the legislation, they did try to balance out the numbers such that what they had in savings in one place, some increases balance some tax savings in other places. When they put in the bonus, kind of another feature, kind of the opposite side of things, was they took away something. One of the things that they did was put in place a limit on some interest deduction. So this is basically on a business, and there's an exception that I'll jump to right away, that if you're under 25 million of gross receipts, this limitation doesn't apply to you. But the limitation is 30% of your adjusted taxable income. So they want to, if you're going to put in $1 million piece of equipment and totally finance it, you get the deduction of the $1 million for the piece of equipment. You might lose out some of the interest on the financing depending on what your income is. You can carry forward if you're limited and you can't take the interest, it does become a carry forward, so it's not totally lost, but it might be lost in that calculation. But you might not need it if you've wiped out your income with your bonus depreciation. You might not need that financing in a particular year. The interest expense limitation, if it does apply to you, you have a couple of options too, depending if you're in the real estate area, because you will see a lot of financing in the real estate area. You can put an election in place not to take the total bonus depreciation, but to take a different depreciation method. And if you take that different depreciation method, then you don't have to worry about the interest limitation. If you have floor plan financing, and you'll see the floor plan financing is for a motor vehicle situation. If you have floor plan financing, those tend to be high gross receipts industries. If you think of a car dealer or a truck dealership where they might finance their fleet of vehicles, that floor plan financing for the cars that they may sell is offset with the interest and that's allowable. You don't count that interest expense in the limitation. If you have a significant interest income, that will help you, and you do the test for the 30% of adjusted taxable income by adding in certain items. So you don't have to count the depreciation that you've taken before you figure out your 30%. So it may be a limited application to those that this particular provision applies to, and it can be planned around a little bit.
I would imagine, Jana, right? I mean, for most of our clients are seeing by the time, that second bullet point there where it computes adjusted taxable income, that's essentially an EBITDA calc, right? By the time you do that and apply your 30%, it's hard to envision too many situations with our client base that would be affected by it. There's always exceptions, right? But I think for the most part, hopefully they're not impacted negatively by it.
The next provision could affect some of our clients in a more significant way. Losses for taxpayers other than corporations are going to be limited to $500,000 on a joint return and $250,000 on an individual return. This is a netting process. So if you have one business entity that has $1 million loss and another that has a $600,000 profit, it will be netted together before you determine whether or not you are limited on your business loss. Amounts in excess of the limitation can be carried forward. Because we are losing some of our net operating loss carrybacks, this provision in some respects is not as large as you might, significant as it could have been, because you're really not increasing your net operating loss because you can't carry a loss back anyway. But it is another step in the process of what you're going to have to calculate on your individual return. This loss calculation is after we already had limitations on what we could do on passive losses, that we had limitations on being able to take the passive losses, but now we have a limitation on this situation where it could apply to active trades or businesses, and we hadn't seen that in place before. So you can only have so much room to offset your other income that you may have, such as investment income or W-2 income, by these business losses on your individual return. Your carry forwards of your net operating losses are also going to be limited, both on an individual level and a C Corp level, although the limitations are slightly different when you can take those net operating losses into the future. Then we just have some other miscellaneous provisions. Like-kind exchanges, you used to be able to do, we saw a lot of like-kind exchanges on auto, sometimes pieces of equipment. You might have in a like-kind exchange where you don't recognize a gain on the sale of the piece of property that you're exchanging. Well, those exchanges are still out there for real estate, which is where the biggest implication lies, where you usually have appreciation on a piece of property. You can still do a like-kind exchange as long as it's not inventory property. You can still do that exchange and escape taxation if you don't take the money but exchange it for a different property. But you cannot do it now on tangible personal property. Because you can take full bonus depreciation on the new piece of equipment in tangible personal property, that's probably doesn't have probably very big implications for many taxpayers, but it is a change. They did talk about changes with research and development, but there has been no change to the credit. One thing that they did do with research and development, and this doesn't apply immediately, but will apply effective for years beginning after January 1st, 2022. You used to expense immediately your research and development expenses, and now you will need to start amortizing those over a 5-year period. So that could have some big implications. And I already had mentioned the repeal of the domestic production activities deduction, but that is gone for years after 2017. Another small change was on self-created property. This is something that if you were coming up with something to say that you're going to patent and you sold that technology, you were the one that developed it and sold it, that will now be treated as ordinary income property instead of capital gain property. Could be models, designs, or secret processes. Any of those items now will be ordinary income instead of the more favorable capital gain. They did come in with a new credit that is the employer credit for paid family and medical leave. It does have to be a specific plan. You can't just say that something you currently have or are giving your employees for vacation personal is under this particular provision. It's other than vacation or personal time off that you're currently giving. But there is a 12.5% credit for 50% of the employees' normal wages. They did tinker a little bit with an employee achievement award. If you had a length of service award, you can still do an employee achievement award for length of service or for safety, but you cannot give a gift certificate or a cash or something that's easily convertible to cash. You can still do golf clubs or a watch or something similar tangible personal property as an employee achievement award. You just can't take a deduction for doing something that would be a cash or cash equivalent type item. Getting to a couple of the last slides on the business deductions. Meal and entertainment has been a big one. We still have in place a 50% deduction for meal and entertainment, for meals that relate to travel or employees' travel or use for business. What is gone now is any entertainment expense. Those are non-deductible. So if you do take somebody out for a golf outing, the round of golf is no longer deductible. We had already seen that the club due for joining a country club was not deductible, but now they've extended it to entertainment that you might do. Or perhaps it's tickets to a Bucks game, no longer deductible. You can still do it as a business, obviously, if it's for business purposes, but you won't get the tax deduction. What we would recommend here is as you're running your business that you segregate your costs now rather than waiting for the end of the year when you're going through and we're going to ask you the question, how much did you spend on entertainment? So start a separate general ledger account would be a good idea to segregate out those costs if you do have any. There was also an expansion. There were some situations where you may have provided meals, perhaps to even a facility at your own employment, at your own company. Those facilities now are 50%, the meals at those facilities are 50% deductible. They were 100% deductible, so that is a change as well. They are going to be non-deductible in the future, but that is several years off at this point. They tinkered a little bit with the membership dues. I had previously mentioned country club dues were not deductible in the past. They've added the word business, pleasure, recreation, or social purposes. Those club dues are not deductible as well. And if anyone did previously provide transportation benefits, this might be parking, say, downtown, or carpool, or other fringe benefits related to transportation benefits, those are no longer deductible. It doesn't mean that if you provide them, the employee, it can still be excluded from the employee's income, but it would not be deductible from the corporation. And now, because I think you're probably tired of hearing me talk, I'm going to turn it back over to Mike so I can move on to the accounting method changes that are out there.
Thanks, Jana. So we're just about done. Just a few other things to cover here. Like Jana said, we have some accounting method provisions. So under this slide, if your business has had average gross receipts over the prior 3-year period, there are some changes which may necessitate some additional conversations and consider potentially some method changes. So If your business falls within this category, and a lot of our clients do, there are some things here that we want to cover. So the first couple really relate to accounting for inventory. So, and these are all good provisions, I would say, is that there's going to be less restriction as far as accounting for inventory for tax purposes. We're allowed to use the same method as used for financial statement purposes or treat as non-incidental materials and supplies. So, so that, in most cases, we'll probably be relying on what's used for financial statement purposes. But the second item there is the elimination of the UNICAP rules for taxpayers that fall within these guidelines. Again, 25 million in gross receipts. We'll be looking, this case, for 2015, 2016, 2017 gross receipts, divide by 3. If we're less than 25 million, then we can apply these. That UNICAP elimination, that I can envision that being fairly significant for a number of taxpayers. You may not keep track of it that much because it's just this item that creeps up or down a little bit each and every year, but over time, if we've been growing the business and 10 or 15 years have passed, that could be a really large deduction that we're going to get in 2018. So we'll have to keep our eye on that and certainly be in contact and communication with you on it, because that could certainly affect kind of the planning that we do for 2018 as well with tax estimates and whatnot. A couple of other provisions. And these are two, the cash method of accounting becoming available, regardless of whether the purchase, production, or sale of merchandise is an income-producing factor. So historically, businesses that fell within that category for maintaining inventories, things like that, were required to be on an accrual method of accounting. But the cash method now could be available. So that's one of those items I think will really necessitate some separate discussions one-on-one with our clients to determine if it makes sense. In some cases, it could actually be detrimental depending on which way your receivables and payables are going, but it's certainly something that we'll want to be in a communication with you on and determine what the best course of action is. Also, long-term construction contracts, which would historically been required to be accounted for under the percentage of completion method, can now be accounted for under completed contract method. So that's another one of those that will just require some separate analysis and talking with you folks as far as what the options are there. Okay, so last couple slides here, we'll touch on international tax, and I think we'll be pretty much wrapped up. So the international tax provisions as part of this bill, just highlighting, no changes have taken place for IC discs. However, the benefit will certainly be reduced somewhat, and that's just based on the fact that the spread between the qualified dividend rate, which is 23.8%, that stays constant, and the top rate potentially, or the rate for businesses that say get this qualified business deduction, as Jana mentioned, 29.6%. So there's just not, and for those of you who have them, you know what this computation looks like, and that value is just reduced. Now, some folks have asked, should we get rid of our IC disc? And my comment to that is, if you already have one set up, I just don't see any reason to terminate it at this point. There's still going to be some benefit to it, but if you were kind of on the cusp of whether it made sense or not to do it, I think those thresholds for international activity have just escalated pretty significantly. So the next bullet point there, so this is the big change going forward, is this movement from a worldwide system of taxation, again, and Jane had touched on it earlier, as U.S. taxpayers, we're taxed on our income wherever it is generated or earned, and even in some cases it might be deferred over in a foreign jurisdiction, but ultimately when that income comes back in the form of dividends, it's taxed again in the United States. There's foreign tax credits, things like that. But generally, that's our U.S. taxation system, or historically what it was. So we're moving from that system to what's called a territorial system of taxation, where your income tax is paid where, in which jurisdiction it is generated. So that's kind of where things are headed going forward. In order to apply those new rules or provisions, there's this third bullet point there, an exemption from U.S. taxation for certain income attributed to foreign subsidiaries. So in this case, there's a 100% deduction of foreign source dividends, and that would be from 10% or more owned foreign corporations, okay? So that provision is only available to C Corps, and in fact, C corporations that are not RICs or REITs. However, there's this new inclusion for what's called global intangible low-taxed income. So despite what I said about moving from a worldwide system of taxation to a territorial system of taxation, this bill includes some provisions which, at the end of the day, are effectively going to tax some of that foreign income in the U.S., depending, and this is where, Jane had talked about it earlier, regulations and more guidance needed from the IRS as far as applying some of this, but generally speaking, to the extent that we have this global intangible low-taxed income, there will be a tax in the United States of 10.5%, which is exactly half of the new C Corp rate of 21%, and then that ticks up after 2025, and that is available only to C corporations that own these foreign subsidiaries. For non-corporate taxpayers, they'll pay tax at the regular applicable tax rates, which would obviously include your S Corp shareholders as well. And the whole idea with that global intangible low-taxed income is really to preclude U.S. companies from moving low-basis assets into foreign jurisdictions and just continuing to make more and more money over there without necessarily any consideration for sending it back to the United States. So that's in there to at least ensure that there's some U.S. tax on our U.S.-based multinational companies for the most part. Last slide. So we talked a little bit on the previous slide as it relates to international tax issues is what we're looking at going forward. So in order to look at what we're doing going forward, there has to be something we have to take care of for all of our accumulated profits that we've been building up historically to get to this point. So what we have is a transition rule here for current deferred income, and it's highlighted there's repatriation of accumulated foreign earnings. So there's a specific tax rate that the bill includes. So it's 15.5% on cash and cash equivalents and 8% on other properties. So to the extent, it's essentially your retained earnings for the most part that your foreign subsidiary has accumulated over time. And now we're going to pay tax on that. And that tax is going to be paid regardless of whether we bring those dollars back or not. So, as part of this whole bill, whether it be a windfall of tax revenue as a result of this, there certainly will be a lot of that. And I don't know if this is going to be good or appropriate for the economy and all that kind of stuff, but there will certainly be a lot of tax being paid as it relates to this. However, there is an election to defer and pay it over 8 years, so it's not something that's going to come through all at once. And there's a schedule there for the timetable for paying that tax liability. And under all of the provisions, there's no interest attributable to that. So unless there's some unique circumstance, I don't know why any taxpayer would not make the election to defer and pay it over that 8-year time frame. So that applies for C corporations. Now, S corporation shareholders, that next point down, actually have an opportunity and a little more flexibility. They can continue to defer payment until a triggering event occurs. So they define that as either termination of S corp status, liquidation or sale of the assets of the S corp, or transfer of the S corp shares. So the S corps that own a foreign subsidiary that have these the accumulated earnings in them don't have necessarily an immediate tax that they need to consider as long as they continue to operate the S corporation, no sale takes place, no major share transfers as well. So a little more flexibility for them. There's also various changes to the Subpart F rules, and some of this it's way beyond the scope of this hour and 45-minute discussion, and these international tax rules are quite complex. And like some of the other things I talked about too, these are just going to necessitate some separate discussions. We have pulled a list together of our clients that have foreign subs. We're continuing to stay on top of the guidance that's out there and getting educated as how some of this will be implemented, because for some of them, it will be a significant event that needs to be handled properly. So with that, I don't have anything else other than my comments. So again, just thanks for being here and braving the elements out there. It was great to see this many people. I was thinking it might be a third of this as far as attendees. But again, this is where the work starts for us. It was great to get everybody together, and I think just to put some ideas out there for you and some of the changes to the law. But we don't expect you guys to figure this stuff out. That's what you pay us for. So there will be a lot of separate strategic discussions, especially I think that the area that Jana touched on, the qualified business income deduction, is going to necessitate a lot of potentially modifications to the way things have been done, whether it be through salaries, related party transactions, in order to get full benefit of that. So we'll certainly, if we haven't, we'll be in touch with everybody. We've got the tax filing season coming up, so we'll be looking really closely at a lot of the numbers and think about what 2018 is going to look like for a lot of folks, and obviously relay that information to you. So, and we'll be around to answer questions and things like that too. So I don't know, Jana, if you had any.
No, that's the same thing I was going to say, is that we will stay around, so if you want to come up and ask us whatever questions, we'll try and field any questions that you may have. Hopefully we haven't totally confused you, but.
Yeah, there's a lot of moving pieces, but like I said early on, I think overall it's positive news for most folks. Just please let us know if you have any questions or other comments.
Thank you.
Thank you.